Thomas Green here with Ethical Marketing Service. On the podcast today, we have Sanjeev Chitre. Welcome, Sanjeev.
Thank you. It's absolutely a privilege to be on your show, Thomas. Thank you for inviting me.
It's my pleasure. Would you like to tell the audience a little bit about yourself and what you do?
Well, fundamentally, I can be classified under the category of an entrepreneur with the passion of being a serial one. What is an entrepreneur is a subject to a lot of definitions. But the simple thought process for me in this is to drive to creating reality of what you think is feasible within the capabilities of you and your resources to drive and success and measure success. Some measure in terms of wealth, some measure in terms of capture of social impact, but that is, to me, a definition of an entrepreneur. And if that is the definition, then I consider myself a lifelong serial entrepreneur. So that's
what would you say the major distinction between being an entrepreneur and a serial entrepreneur? What would you say was the difference?
Well, in my opinion, only the difference is the madness continues. I believe that once you get the inspiration and the feeling of boundless operational minds, which typically what entrepreneurship is driven by, then containing that mind again is a very difficult process. And so most entrepreneurs, whether they fail or they succeed, stay in that state of existence. So for me, entrepreneurship is also a state of existence. And stay in that state of existence because it allows them that freedom to operate in the space they are the most comfortable with. So those people that continue that and do not get daunted by the social impact for the family needs, of course, and transform from maybe a try at an entrepreneurship to back to what they were doing and comfortable. Then other than that, I believe most of entrepreneurs are minded to be serial entrepreneurs. That's my overall thought process. So I am in that category, a serial entrepreneur.
There's a lot of evidence to suggest that it's exactly the case, that as soon as someone stops, or let's say they sell their company or something, they're unfulfilled, they want to get back into it. So is that kind of what you meant?
Yeah. See, but this, if you consider selling on the company as a necessary criteria for serial entrepreneurship, then you are really limiting the serial entrepreneurship people to those who define success as exits, right? In my opinion, true serial entrepreneurs are those who never give up of trying being in the business or the profession or the mental state of being an entrepreneur. Because as you know, very few exits overall, whatever the statistics are, 2, 3, 4%, whatever the numbers defined or categorized. But I call it the grit entrepreneurship, because you have 99.9% of these global entrepreneurs really, really working hard each day and deal at transactions after transactions or companies after companies. But and only a few of them really, I can categorize them as glamour entrepreneurship, where they never have to worry about the resources, the cash, there's more than what they need and things like that. My book really is not meant to address glamour entrepreneurship. It is meant to really address the mindsets and potentially enhancing the success for the grit entrepreneurship space.
I'd like to, you said that the book is for grit entrepreneurs. What would you define, what's the definition for a grit entrepreneur?
So in general, as you have known and your readers and listeners know, that entrepreneurship is a lot of challenges taken at a time. by a person or a team. And these things are mostly financially oriented, technically oriented, process oriented. And those, each one of them require a tremendous amount of mental and obviously financial resources. When I define great entrepreneurship, I define that as operating in scant resources. You don't have the venture capitals when they are funded. They fund a company. Typical example is the Vision Fund. You want 10 million, I'll give you 100 million. So then the entrepreneur doesn't even know how to spend the damn $100 million, but now he is on a spending spree of creating whatever is possible. Now, I'm not saying which is right or wrong. I'm saying that doesn't require leveraging, thinking, getting up at 4 o'clock in the morning, staying till 12 and worrying about where the next paycheck is going to come from. All of that, or what would you pay to the supplier? How would you negotiate terms with the supplier? How the hell are you going to tell this consultant your stock that is worth not yet anything that he could take in return for the cash? Those kinds of resources that you have to fight for in order to build success, I believe contribute to great entrepreneurship.
Yeah, I know exactly what you mean. So I've been there, I suppose is the way I would say that. So the book is called What Not to Do in Entrepreneurship. Why should entrepreneurs read it?
Yeah, so this is one of the purpose of the transformation of minds. I'm not saying that the entrepreneurs should read all the book. I'm saying the entrepreneurs can look at the challenge that they are managing and read a chapter or two to guide them into some of the things that will help them get tools. Now, why? What not to do? So, as you know, Thomas, there are hundreds and thousands and millions of books and videos on what to do. The challenge with what to do is that what their cases of what to do are so general that and every entrepreneurial venture is a customized transaction by itself. So you are now using the rainforest, kind of the rain falls everywhere and hope you get the damn, seeds out of it. The entrepreneurial minds of what to do are more of, overall framework, but most of the time, entrepreneurs are learning on the job. And they think that is a part of their greatness. That is a part of the definition of an entrepreneur. I call it swimming up the Niagara. And you can understand that if that is a measure of your success, then that's okay. But the measure of success of entrepreneurship is not swimming up the Niagara, but swimming down the river to achieve the success and the goals that you want to do. Mm-hmm. So if entrepreneurs can have various tools in a toolbox of what not to do. For example, when you were a child, your parents were constantly telling you, don't do that, don't do this, don't do that. So as I'd say in my thing, sometimes I thought my name was don't do that, kind of. And the thought process for that is for us to learn that poison kills you or something hurts you should not be your experience, it should be your knowledge. And with that purpose in mind, I began to think about providing the tools in what not to do. Now, the purpose of the book or the information is really to do a transformation in the entrepreneurship space. And that is because today, with all these millions of books and videos and people who don't even have never been an entrepreneur writing about what to do, and writing videos, and they've never started a damn company, but they write books and videos, right? And that is a result because of which the needle of success of entrepreneurship has not changed. And even though the number of entrepreneurs are growing like crazy, the success percentage needle is still stuck between 2 and 3%. And that is because if the most of the people are repeating the same mistakes that other entrepreneurs are doing unknowingly. And so therefore, if I can provide them pathways to avoid those mistakes through of my personal experience and the experiences of a multitude of entrepreneurs in different fields, successful and failed, men and women, different cultures across the globe, and bring that knowledge in a summarized manner, including their experience to be shared on the video, then that is what would really help, I believe, entrepreneurs. That learning of what not to do will enhance the use of the resources, enhance the time of success, because in learning what not to do in business, a lot of time and resources are wasted. And so I would like to enable those tools, not just my personal knowledge, but a collection of the wisdom of different entrepreneurs in that space. And that is why I decided to write the book, What Not to Do in Entrepreneurship. In one line, I wanted to transform the art of entrepreneurship, which is defined by because it is a probability of success, into a science of building wealth through tools in what not to do. That is my purpose in writing.
Well, it's a good answer. If I'm understanding the metaphor, the book would be the parent, the advice is the message, don't do that because you'll get hurt, and the child is the business, and yes, the advice is going to stop them from getting hurt, which is essentially in the market. Is that accurate?
Yes, absolutely. Very well put. Very well put, Thomas. Very well put. Thank you for that.
And is the book for all businesses? Can you apply the principles in the book to each and every business or entrepreneur?
Yes. So, entrepreneurship is like I say, is a mental training. It's not a profession. And so what I have done is classified the different types of entrepreneurship into horizontal entrepreneurship, vertical entrepreneurship, disruptive entrepreneurship, opportunistic entrepreneurship. And so different businesses fit these different profiles. For example, if you are just opening up another hotel, then I call that under the area of horizontal entrepreneurship, because you are replicating what is. If you are going up and down the supply chain, if you now have a grocery shop and you want to open a restaurant, I call that a vertical entrepreneurship, because you're going down the supply chain or you're becoming a distributor. I'm just giving you examples of that. Or disruptive entrepreneurship is, somebody comes up with this crazy idea of replacing travel agents, and now you have a disruptive entrepreneurship. And obviously there are more criteria than that. And opportunistic entrepreneurship it is pandemic now and you want to produce more of your sanitizers. That's, to me, is an opportunistic entrepreneurship. So by categorizing broadly such different versions, businesses, I believe I can at least provide some tools in each of the space of entrepreneurship.
Okay. And regarding capital, which is obviously highly important to be successful in entrepreneurship, can you highlight some of those principles that you talk about in the book?
Yeah, capital is the nerve and the heart and the blood of the business, right? And so although we are addressing the space of great entrepreneurs, capital is still a strong source now of enabling success. And so given the importance I need to give to capital, it is the largest chapter in the book. And the reason being, because not only is the sources of capital important to resonate with the need and the time of the business, but it is the type of the capital that is also critical. And as you know, Thomas, the fundamental of life is driven by golden rule, the man with the damn gold rules. Right? So, and entrepreneurs, nobody better than them and their team know what it is to require to drive success. But when you take capital, you are driven by different constraints, especially if it is venture capital where their purpose of investment and your purpose of creating a successful company could be entirely different after a certain period of time. And so my sort of looking at the spectrum, I call it the spectrum of capital, is in three spaces. What I consider as the angel or the emotional capital. Emotional capital is, I like Thomas, I like his venture, let me write a check, and I know we will do well. Oh, that's family and friends, and you have maybe even some angels put into that category. Then the other spectrum of that is what I define with a very strict word called cutthroat capital. The cutthroat capital is where I don't care, Thomas, what your venture is. If my numbers are not done and you don't meet, I am done with you. And there is no emotion, or there is nothing engaging in that. It's a pure numbers game. I call that private equity is an absolute example of cutthroat capital. Venture capital, depending upon the source, most of them end up in that space. Mm-hmm. And then, because of the wealth of the globe is expanding so significantly now, which is private wealth or family wealth, or other loans and bank, that creates a category of capital called logical capital. And logical capital is where their returns are expected are logical. They are not looking to control, they are not looking to drive. And that resonates perfectly with the entrepreneurial sources. Of course, entrepreneurs must learn to do risk mitigated executions, because otherwise they are playing with other people's money. But at the same time, having a source of logical capital. So in the book, I define the various sources of logical capital. And there is nothing wrong, by the way, with tapping into the cutthroat capital when you know that that is what you are handling. And there are certain criteria that best suit in that kind of space. So in this source of capital spectrum, my purpose and guidelines and thought process that I share are related to being in control of your destiny by defining the spectrum of capital. So capital is like dollars, pounds, whatever the currency is. If you put through a prism, you can see the various colors or various types. And so my purpose is to enable the entrepreneurs to see those capital in various lights so that they can have the choice of choosing and resonating and partnering with the right type of capital, and not get involved where you work for 4 years and then somebody makes a decision in your destiny and all that time and efforts have gone to waste. And again, the purpose is to enhance the probability of success of the entrepreneurship.
Good answer. There's a phrase which I'm interested in, which is, as I understand it in the book, which is moving the needle of success. Can you go into that a bit?
Yeah. See, when you speak of entrepreneurship in a layman's term, the first thing they associate that is risk. Well, it's very risky, And what does that mean? It's very risky. What does that mean? And the way they get that feeling is because they have heard that when 10 ventures start, maybe one succeeds and the 5 fail in the first year and the 3 fail in the next 4 years and the one becomes average and one becomes something. So they've heard all of these things. And so that is associated. And then there is, of course, the real data. How many entrepreneurs after 7 years still stay in business? And that data on an average over the last 10, 15, 20 years, as much as technology has evolved, has consistently showed that it is between 1 to 3%. So that's what I meant by the needle. You press on the accelerator, but the needle doesn't damn move. It stays at the 1 to 3%. So that is the sort of reference in moving the needle. And if I can enable, or we can enable that needle to move, which then transforms the art of entrepreneurship into the science of success. And that's where I like to get the needle, provide the tools so we can move the needle. And the way needles moves is by putting science behind it, not by, just doing the same thing over and over again, because, the definition of insanity is doing the same thing over and over again. So the needle is not moving, which means that entrepreneurs are doing same things over and over again.
Really interesting, isn't it? How society has changed so much, how technology has changed so much, and yet those numbers don't change.
Don't change, yes. And it is because potentially most people may be doing the same thing over and over again because it gives the same damn results. So that's my sort of thought process there.
It's a really good point. Why is driving exits important as an entrepreneur? And how is that different from increasing shareholder value?
Increasing shareholder value is an ongoing process. Driving exit is a measure of the success of that process. You cannot drive exits effectively if you have not disciplined yourself to increase shareholder value all the way through. You can do a fire sale of anything. A company that's worth $10 million, you can sell it for $500,000 to somebody. That's not driving exits. Right? That's decimating shareholder value. So I want to speak about building the shareholder value first, and then I will address the thing about how that transforms into driving exits. Every entrepreneur, most of them, are always focused on building a product or a service that they think will improve either the quality of the life, value propositions, whatever the current marketplace is. And they get engaged. But what is important is they don't realize that every company has two products or services. One is the element by which they are able to engage the value proposition. And the second is the shareholder value, because entrepreneurship, no matter how you put it, is at the end purely about building wealth. If somebody is not measuring entrepreneurship and building wealth, then they are not in the business of entrepreneurs. It is because it has to be associated with wealth. Now, measure of wealth may be different, but wealth is the end point of entrepreneurship, of measure, right? So shareholders are a part of that wealth process. And because whether you are a shareholder, your management is a shareholder, your grandma is a shareholder, or your investor is a shareholder, they are all shareholders in that enterprise. So an enterprise must and always be aware that it has two products. One is the business that creates the transaction, and other is the shares or the currency that measures that value. And shareholder value is that currency that measures that value. Now, you can have a shareholder value and not have any ability to capture it. So capturing that value is done by exits. Now, exits doesn't necessarily always mean that you have a liquidity event or an IPO or an acquisition. If you take exit is a measure of increasing value from point A to point B. Right? So therefore, if an entrepreneur and team has started and then at point B, a preferred round comes in and some of your initial shareholders want to liquidate a little bit of their holding, that is exit. But rest of the people have not exited. So exits cannot always be affiliated with liquidity. It is a measure of the benchmarking of the value for some and measure of the and getting some liquidity out for the other. Although in the minds of the entrepreneur, exits and liquidity are the same. So if entrepreneurship is about creating wealth, then entrepreneurial minds must be trained to driving exits. Right? Now, driving exit is a science, Thomas, because you have the oh shit effects, in it. You look back and you say, oh, I got $10 million for my company, $100 million for my company. But if I would have done that, I could have gotten more. Well, could have done, would have done, don't matter. So the reality is that if an entrepreneur must engineer an exit, he must place a mirror at the time at which he thinks he or she thinks does need an exit. Then you can look back in that mirror and say, what could I have done to drive maximum value? And then engineer those elements in driving the exit. So when I say driving the exit, I mean planned exit, not something that somebody comes and says, oh, I'll give you a check tomorrow. And those are very rare. Because you want to convert this into a science, you have to engineer them. So engineering exit is a part of training entrepreneurial mind, who must understand that shareholder value must be consistently addressed during the process of driving exits.
So kind of like, would you say cause and effect? The cause being shareholder value gives the effect of a profitable exit.
That is absolutely correct. That is absolutely correct, Thomas.
Okay. The next few questions are, I took a look at the YouTube channel. Great content, by the way. So if anyone listening is interested in more, then, there's lots of good stuff. And one of them is your principle on keeping it simple. Can you tell me what that means? And also, do you think that people should, or entrepreneurs should, keep it simple in business?
So this is, by the way, a lot of things that I learned through my experiences, right? So I can share with you the transformation that I have gone through. And of course, when I interviewed other people, I also find the same thing. So I was not the lonely character doing that, but it's the same thing that I said. We all make the same damn mistake. That's why the needle doesn't move, kind of thing, right? So keeping it simple, sir, I call it, not stupid, The purpose of that is for an entrepreneurial mind is trained to be a complex mind. The more complex a solution, the more achievable or the more genius entrepreneur thinks his mind is. Because they'll try to figure out how can this be done and how can that be connected and how can that be leveraged. It's an incredible exercise in intelligence. But it creates a very complex situations in execution. Because, for example, as I say in the book or any other things that you can, if you want, entrepreneurs like say, oh, you know what, I want to do a funding, but I can do one funding. And by the way, if I do that funding, I can leverage that to my distributor and have him put the money in. And so they're concocting all this success in their mind. And it looks good on the piece of paper. Oh, I can leverage A to create the value and leverage B. It's the lady with the milk, the spilled milk story, right? So carrying the milk, and I can sell the milk in the bazaar and buy the cow and etc., etc., etc. Right? The reality is that complex transactions or complex thought processes are uncontrolled by external environments. And for example, if you are doing an investor and a distributor funding at the same time, at the same round, for example, something goes wrong with the distributor because the guy left his job that you were negotiating with. Now, suddenly, what you think and what you see is the distributor pulls out. Now, okay, the distributor pulls out. The investors now think something is wrong. They pull out. So, creating complicated transactions reduces the probability of success. So hence my thought process in everything, even in engineering, the same thing. Keep it a simple, achievable goal you feel achieved. If you keep it complex, the matter doesn't double, the risk doesn't double, it squares or even quadruples. And so that's why my request to keeping it simple, sir, in the book.
Not sure why, but have you heard? It makes me think of minimalism. Have you heard of minimalism at all?
Yes. Yes.
Sorry.
It is. It is a way. It is Thomas in a way about minimalism, but you know, minimalism drives to use less things. I am saying just break it down into smaller pieces so you can execute what is manageable and measurable. Because one success builds on other, but when failure occurs, it's a house of cards. All of it comes down.
So I know you've touched on private equity a little bit already, but you did a specific video on it. So can you go into what private equity is, once maybe in a little bit more detail, and whether you think entrepreneurs should use it?
Yeah, first of all, private equity, like everything else, there's good private equity and there is, not so good private equity. But overall, in general, private equity is not meant for initial early stage entrepreneurs, right? Private equity is a source of capital where the company or the organization that is offering the capital, they put a little bit of their money and they go, because of their track record, they go to institutions and they have a significant amount of capital available that they invest in leverage existing cash flow. So private equity's fundamental business is to acquire or invest in companies that have cash flow, that are established, that are predictable, and that they can then take that cash flow and put a significant amount of debt on it with some small amount of equity underlining. Most of that capital may come from themselves, or the debt can come from outside institutions or banks. And then the cash flow that is typically used to give to return to shareholders, to investors, or to improve the quality products of the company or the structure of the company or hire more people, is now used to pay the debt that is put on the balance sheet. But since private equity business is fundamentally to provide debt, service their debt, and then try to get as much capital that they invested in back, and then sell it to somewhere else. So private equity has a 5 to 7 year term in which they kind of churn this capital. And so private equity is not good for entrepreneurs, because it constrains and chokes immediately the business cash flow. But if you, and by the way, private equity has no mercy, so they'll bring their own people, their own teams, and very quickly they promise the world, and in less than 1 year, the management team is gone. Because they want to take control. They don't want resistance. They want to take control of the operation. They want to take control of the bank balances. They want to take control of how they finance all of that stuff. And so in that case, the only time it is good for an existing business that entrepreneurs have is if they say, okay, I don't want to be with the company for more than a year or so, and I want to take my cash and leave. Now, that is only the situation. That is good, but that requires an established business. So A, private equity is not a source of capital for early stage entrepreneurs, and B, it is for sure not a friendly capital. And that's why private equity is the worst kind of cutthroat capital. I mean, even in established businesses, Toys R Us was destroyed by private equity, right? Or, so many Sears was destroyed by private equity. I mean, go one after the other. And you see that those are big corporations, by the way. Think about what a poor entrepreneur would get there, right? But I have seen enough people who sell their business knowing that year from now they'll be thrown out. But hey, if they've gone, they can do something else. That's definitely, there is a place for that kind of thing in private equity.
Is this from experience for yourself, or is it just observations that you've seen this happen?
No. So I have never sold my business to private equity, but I have been engaged with transactions that private equity has been involved in. And so I have seen it from the capital side. I have seen it from the company side. I have just not accessed private equity for myself.
On purpose, then?
Well, now, now that looking back at it, it was the smartest thing to do at that point in time. I probably didn't have a business that was of that level of interest to private equity, but because I used public instruments more often, where keeping control of my destiny was critical for me.
Okay. And I like this one because I think it will help with moving the needle. What does it mean to be penny wise and pound foolish in entrepreneurship?
So, we as entrepreneurs always like to be recognized for the everyday effort that we do. In small ways, big ways, in society, in our colleagues, everything like that. And so that's one element, or one sort of box. The other is, we always think that the image creates the success. Right? So entrepreneurs will, say, hey, I don't want to buy that expensive computer, but I would like to hire a PR firm to let customers know how we are successful. You see the dilemma now. Buying the best computer tools is useful for the business. The PR is just a mirage in the reality of the marketplace. So those things of facade, great facilities, great furnitures, all that kind of stuff that you can enjoy when you are successful, that if you give them the priority or the importance in the early years, you are taking away from the value that getting the biggest bang for the investor or your buck that you have put into the business. So you don't need the product, the quality, the service speaks. So invest in that business rather than going to fancy shows and having great booths and pouring money, which at the end of the show nobody gives a rat's ass about it. So that's what I meant by don't be penny wise and pound foolish. Penny wise being in not investing, say not getting the best tools because you know that. But investing in something that you don't know what the returns are or will be or shall be, just because the image kind of builds up. That was my thought process there.
Do you think people, when they're pound foolish, do you think they're almost consuming, or do you think they actually think that it will be beneficial for the business?
Most of the time, it's ignorance.
Okay.
Most of the time, it is not understanding the true value. They just look at what they hear outside and they see all these press releases and the guy speaking at an event and they say, oh, then the PR company, which that's how their business. Oh, if you come, I can, put you on the shows and things. So then begin to build that image in their mind of what it can be, when they should really be thinking of how the hell am I going to make my customer happy?
Yeah, misplaced priorities.
Misplacement of priorities, yes. But priorities, it comes out, and most of the time, I want to give them that it comes out of ignorance. In my case, when I did it, it came out of ignorance.
And what are some of the things that you were pound foolish about, would you say?
Some of the things that I have been pound foolish about is one of the things is just, I had a very small public company, and I've felt that in order for me to increase the stock value of the company, I should hire get to know the people and the marketing and the analysts and all of that, and so I hired a PR firm. So that's one of my particular examples out of that, right? And by the way, see the challenge of all of this thing is when you are doing it, you are justifying it in the right sense of the word, right? Some of these things are hindsights, and I don't want them to be hindsights for people. That's why I included that in these things. Right?
That's why it's in the book.
Yeah. And so the other aspect of the pound foolish is, you look at investing in infrastructure. This is very important, Thomas. When you go to when you get sources of capital that are easier to spend money on, you feel that you need to build the infrastructure of the business. So when the product goes, you have everything in place. But you are forgetting the fact that the customer demand hasn't built up yet. So this is an operational pound-wise, penny-wise, pound-foolish. So you are putting the infrastructure, but you are not putting the money where where the engineering or the things like that are. You are putting it in a manufacturing, outgoing customer service infrastructure. And so that money spent could have been better used in enabling success of the product build. So this, I gave you an operational, and why it happens, because you now have the capital sources saying, hey, you have to build scalability and you have to have this infrastructure, so you must hire these things. And you know that it is going to take you a long time to get the product to be reliable space and everything like that, but you're not trying to hire more engineers there, but you're trying to put more money in the infrastructure. So again, penny wise, pound foolish in an operational sense.
You are managing director or owner of the U Group, is that right?
Yes.
If you had a potential prospect, what would the process be for them? What does that look like?
So in the U Group, we do various kinds of transactions, Thomas. We don't do very, very early stage engagements because that is a business that requires a lot of people focus, and our focus is to deliver shareholder value in the 36 to 48 months, about anywhere between 3 to 4 times the invested value. That's our mantra, and we seek the other element of it is the 1 + 1 = 11. And the reason, Thomas, this is very important in that period of time of execution, is because every time you put together, if it's not very clear how the 1 + 1 = 11, then 1 + 1 = 3, everybody can show you, or 4, but they screwed up. And then 1 + 1 becomes 1.5, so you have degraded the shareholder value. But if you plan and you can reasonably think through 1 + 1 = 11, and you screw it up because 1 + 1 = 5 or 4, you have still increased the value by screw up. Right? So at the U Group, we look for those kinds of projects that allow us, our own money and investors that participate with us, to create that value equation. For example, we are right now in the process of doing a consolidation in the animal healthcare space because of the arbitrage that exists between private hospitals and public hospitals of a critical mass. So I give you an example. So in that 36, 48 months, we would enable the acquisition of what we consider as community capture model. So we come up with an engine, an intelligent engine that enables the value creation process, which is the 1 + 1 = 11. So that's one of the things that we are doing. We also are very supportive of what we consider as the founder control consolidation. You know that, Thomas, most of the time, entrepreneurs forget the value of the buy and build thought process. So suppose an entrepreneur has a company. There is capital available for acquisition, but sometimes it's difficult to have capital available for growth. So, but if you can, as an entity, acquire an infrastructure of you one and they one, and then you can create the value and shorten the time, again, that's the same equation applied of 1 + 1 = 11. So at the U Group, we engage in those kinds of transactions. We have done early stage startups. We do fund our own concepts and company in that area, but those are the ones that we are in full control of. So that's the elements of the undertakings that we do at the U Group in the value driven by the value creation model, and obviously we don't rarely succeed in 1 plus 1 equals 11, but we do succeed in 1 plus 1 equals 3 or 4. So, that's what the whole purpose of what we do is at the U Group.
People don't mind when it gets to 3 or 4, though, right?
Yeah, but you have to, yes. But, you have to really meticulously look at every aspect of it as to how you get there before you begin to, investor and our own money, of course. We always put our own money first before we go out to bring in investor capital.
Do you mind sharing the story of when you were Entrepreneur of the Year?
Yeah. So when I did my second company, by the way, in the last chapter of my book is called My Brain Scan, a journey of entrepreneurship. So, starting from the first entrepreneurship to whatever I have been, if you scan my brain, how would it look like and stuff like that. So a part of that sort of the listing of it is when in the first chapter of the book is Once Upon a Time, and it is my second company where I started a company with 4 people, got a small amount of private capital, and I took it public because nobody else would give me any money to build anything under what was called as public venture funds. And I tell the story of how I met this person who, gave me this opportunity, etc., and my journey through the law offices and stuff, how I got through that. But what that allowed me to do, Thomas, is to have a public company with 5 people with less than $1 million in revenues in the semiconductor capital equipment space, where we changed the way chips were built. Semiconductor chips they would be like Kansas City all over in the chip, and you would never get the kinds of complexities that you get into this unless we had invented the technology called chemical mechanical planarization, where we would layer one chip over the other. It's just like building 100-story building with every story being flat. Think about if the first floor would not be flat, you would have an undulating surface. And so we enabled the technology on the chips to make it flat, so you can now build 100-story, 200-story, 300-story buildings, which is why you see the devices size shrinking. So as a result of that technology, I was at the public instrument that I took the company from 1 million to 20 to 85 to 250 to $475 million, straight up the curve. And of course, during the process, I learned a lot of what not to do, and made mistakes during that process, but I delivered a tremendous amount of shareholder and employee value, and because of that, I was the Entrepreneur of the Year by Ernst & Young. And so I look back and I say, was that a success? Probably yes. Could I have done it better? Probably yes. And Thomas, when you say you could have done it better, probably yes, you say, well, did I fail or did I succeed? Because you could have done a lot better. But those are all just looking back, 2020 hindsight, 2020 sight. So that is why I was given the Entrepreneur of the Year award.
Well, congratulations on that. Very impressive. Can you tell the audience when the book is out and where they can find it?
So we are planning the book to be out by somewhere in the end of the first quarter of this year. Mm-hmm. And we will publish it on Amazon and stuff like that initially. And obviously, we are in the process of seeing what kind of other channels of distributions we can put into. And my goal is to, provide excerpts of the things that you see on the YouTube, more of the chapters, so that there is an understanding in small ways of the content of the book, and what are the tools that each of those videos that you saw potentially is in the book a chapter. And so that allows you to, and obviously you can also see in the book interviews of 15, 20 different entrepreneurs, a woman bank founder, a guy in Dubai creating a social entrepreneur, a couple in Dubai creating social entrepreneurship, the founder of the largest private, debt firm. So I was very fortunate, movie makers and things like that. So I was very fortunate to get a diverse field, and I hope that, and of course I will continue to do these interviews and add to the next, revised versions. But the purpose is to have that kind of a breadth of not only knowledge but actual learnings from the various entrepreneurs through the scan code connectivity to the video. So I expect the book. I mean, of course, we are working on it, but I expect the book to be out somewhere by the end of this quarter.
So probably better to follow you. Where's the best place for people to find you?
So you can follow me on the website What Not to Do in Entrepreneurship, in it, or on the YouTube channels, or on every one of the YouTube videos. We are also creating a What Not to Do LinkedIn group, so that you can follow us on that also.
Well, thank you very much for all the value you have added today. Is there anything else that you would like to add?
No, I wanted to appreciate your time, the questions you asked, and I hope that I provided you some insight into the mind that with which I wrote the book.
I think one thing that's definitely going to stick is to be careful of being penny wise and pound foolish. I have to check myself on that one.
We all do. Thank you so much, Thomas.
It's my pleasure, and I will speak to you soon.
And by the way, what I wanted to do, Thomas, is at the end of the publication of the book, I like entrepreneurs. My purpose is to give an hour or two every day, 15 minutes each, for various entrepreneurs to just call and talk about their ventures, and in some ways seek an open conversation so that they can get to feel, if there are some things that we could, put some light on once the book is published, they've read, they can ask for explanation. And that is something that I want to make a habit of, so that, of course, we can, in every day, maybe we can do 8 or 10, and then in an hour or 2 hours worth of time. But that is one of the, things that we want to offer once the book is published.
Well, be sure to message me when the book is released, and I'll put some social media posts out for people who have enjoyed this video.
Thank you so much, Thomas, once again.
My pleasure, Sanjeev, and I'll see you soon.